Most traders think wealth is built by being right. They believe survival comes from prediction, precision, and intelligence. And that belief is exactly why most of them go broke. The market does not punish ignorance. It punishes emotional attachment to outcomes. When others lose everything, it is not because the market suddenly became unfair. It is because their internal environment collapsed before their account did. There is a secret strategy that keeps a trader rich. Not occasionally, not accidentally, but consistently. And it has nothing to do with indicators, entries, or secret algorithms. It is the ability to operate from a state where loss does not threaten identity, where uncertainty does not create fear, and where every trade is just one of many in a long series. The trader who stays rich is not smarter. They are neutral. They do not need the market to validate them. They do not fight randomness. They do not personalize losses. While others are emotionally negotiating with every tick, this trader is simply executing an edge, over and over, without hesitation, without hope, without fear. This is not discipline through force. This is discipline through understanding. And once you understand this, you stop asking, how do I win more trades? And start asking, how do I stay in the game indefinitely? Most traders believe the opposite. They believe survival comes from better prediction, sharper timing, or superior analysis. They believe that if they can just forecast the next move more accurately than others, money will naturally follow. This belief feels logical, but it quietly plants the seed of destruction. Because the moment you believe prediction is your shield, you become emotionally invested in outcomes you cannot control. The market does not reward certainty. It punishes it. Risk neutrality begins with a simple but uncomfortable realization: you do not know what will happen next, and you never will. Not because you are unskilled, but because the market itself is an environment of uncertainty. Every price movement is the result of countless variables interacting in ways no individual can fully perceive. The trader who accepts this reality stops trying to dominate the future and starts managing exposure to it. Prediction creates attachment. Attachment creates fear. Fear distorts perception. When a trader believes they should be right, every tick against their position becomes information they must emotionally negotiate with. Instead of observing the market, they argue with it internally. They hesitate on exits, justify holding losers, cut winners short, and override rules that were perfectly clear before money was at risk. None of this happens because they lack intelligence. It happens because prediction tied their self-worth to the outcome. Risk-neutral traders experience something radically different. They enter trades already knowing the loss is possible, acceptable, and fully integrated into their business model. The risk is not theoretical, it is emotionally prepaid. Because of this, the market has no leverage over their behavior. Price movement does not threaten identity. Loss does not feel like punishment, it feels like execution. This is where most traders misunderstand neutrality. They think neutrality means not caring. It does not. Neutrality means caring deeply about the process while being completely detached from the result of any single trade. The trader still follows rules, manages size, and executes precisely, but without emotional demand placed on the outcome. When risk is emotionally neutral, decision-making becomes clean. There is no urgency to be right, no pressure to recover losses, no need to prove competence. Each action is based on information, not fear or hope. This clarity compounds over time, because mistakes caused by emotional interference gradually disappear. Prediction, on the other hand, invites instability. Even when a predictive trader wins, the win reinforces the illusion of control. Confidence swells, position sizes creep up, rules loosen, and vigilance fades. Eventually, the market delivers a sequence that does not match the trader's expectations, and the emotional shock is magnified by overexposure. What breaks accounts is not one bad trade. It is the sudden collapse of emotional equilibrium. Risk-neutral traders are prepared for sequences that feel unfair. They understand that randomness clusters. Losses can come back to back without meaning anything about the edge. Because they never expected individual trades to behave, they do not panic when they don't. Their response remains consistent across all conditions. This consistency is the real protection of wealth. The market does not take money from traders because they are wrong. It takes money because they react poorly to being wrong. Risk neutrality removes that reaction. When losing is fully accepted as part of the distribution, the emotional charge disappears. The trader does not seek revenge, does not hesitate on the next valid signal, and does not abandon a proven method at the worst possible moment. Most traders say they accept losses, but their behavior reveals otherwise. True acceptance means the loss does not alter behavior. It does not change posture, tempo, or confidence. It does not create urgency or hesitation. If a loss changes how you trade the next opportunity, it was never truly accepted. Prediction-based trading cannot offer this stability because prediction invites expectation. Expectation invites disappointment. Disappointment invites emotional response. And emotional response is what turns manageable risk into catastrophic damage. Risk neutrality is not passive, it is active psychological preparation. Before entering a trade, the trader defines the risk and mental lie releases it. That money is already gone. Whatever happens next is simply information. This mindset creates a strange but powerful freedom, the freedom to exit immediately when the market says you're wrong, and the freedom to stay in when nothing has changed. This freedom is what allows edges to play out. Most edges fail not because they are invalid, but because traders cannot execute them consistently across changing emotional conditions. Risk neutrality smooths those conditions. It keeps the trader internally stable while the market remains externally unstable. Over time, this stability compounds in subtle ways. Drawdowns are smaller because losses are cut cleanly. Winners are larger because exits are not driven by fear. Overtrading disappears because there is no emotional need to force opportunities. Capital grows not explosively, but sustainably. This is why traders who last decades rarely talk about prediction. They talk about risk, position sizing, and mindset. They understand that markets can stay unpredictable forever, but behavior does not have to. Wealth is not the result of avoiding losses. Losses are inevitable. Wealth is the result of avoiding emotional damage. Risk neutrality is the shield that absorbs the psychological impact of uncertainty. When others are exhausted from fighting the market, the risk-neutral trader is calm. When others are desperate to recover, the risk-neutral trader is selective. When others abandon discipline, the risk-neutral trader continues executing the same edge with the same size and the same mindset. This is not excitement. It is professionalism. Prediction feels powerful, but it is fragile. Neutrality feels boring, but it is unbreakable. One invites emotional volatility, the other eliminates it. One depends on being right, the other depends on staying consistent. And consistency over enough trades, over enough years, is what protects wealth when everything else fails. The market does not reward those who know what will happen next. It rewards those who are prepared for anything to happen next and remain unchanged. Most traders say they understand probabilities, but they still emotionally experience every trade as if it should behave a certain way. They may speak the language of probability, yet trade the reality of outcomes. And the moment outcomes matter emotionally, consistency disappears. The market is not a place where individual events are fair. It is a place where distributions are fair over time. When a trader evaluates success or failure one trade at a time, they are measuring randomness and calling it performance. That is not trading. It is emotional bookkeeping. Probabilistic thinking begins when you truly accept that the next trade is independent of the last one. It has no memory. It does not owe you compensation for previous losses, nor does it promise continuation after a winning streak. Each trade is simply one occurrence within a larger statistical framework. Until this is deeply accepted, not intellectually but emotionally, consistency remains impossible. Outcome-focused traders experience psychological whiplash. A win creates relief and confidence. A loss creates frustration and self-doubt. This emotional oscillation forces them to constantly adjust behavior. They trade larger after wins, smaller after losses, hesitate after drawdowns, and overtrade after missing opportunities. None of these decisions are part of the edge. They are reactions to recent outcomes. Probabilistic traders remain unchanged. They do not feel hot after winning or broken after losing. Their behavior does not depend on recent results because their expectations are not tied to any single trade. They expect variance. They expect clusters of losses. They expect streaks that make no emotional sense. Because of this expectation, nothing feels abnormal when it happens. This is the psychological foundation of consistency. Thinking in probabilities means accepting that an edge does not express itself in neat, predictable sequences. A strategy with a genuine advantage can lose multiple times in a row without being broken. When traders do not internalize this truth, they abandon edges right before the probability curve begins to work in their favor. The market repeatedly transfers money from those who cannot tolerate variance to those who can. Outcome thinking makes traders fragile. It creates an emotional dependency on being right. Every trade becomes a referendum on intelligence, discipline, or self-worth. In this state, losses feel personal, and personal losses demand emotional resolution. That resolution often takes the form of revenge trading, system hopping, or abandoning rules. Probabilistic thinking removes this pressure entirely. When a trader knows that no single trade carries meaning, there is nothing to defend. There is no identity on the line. The trader is free to execute without emotional interference. This freedom is not passive. It is the result of structured expectations. The trader knows the historical win rate, the average loss, the average gain, and the expected drawdowns. Because these realities are pre-accepted, they do not come as emotional surprises. Surprises are what destabilize behavior. Most traders are surprised by losing streaks even though they are mathematically inevitable. They say they understand probability, yet emotionally react as if something has gone wrong. This disconnect is where consistency breaks down. Consistency is not discipline under pressure, it is the absence of pressure. When you think in outcomes, every trade carries hope or fear. When you think in probabilities, trades are simply executed. The difference is subtle in language, but massive in impact. One invites emotional interference, the other eliminates it. Probabilistic traders do not need reassurance from the market. They do not need to be right now. They are operating on a time horizon where individual events are irrelevant. Their focus is on executing the process faithfully enough times for the statistics to assert themselves. This long-term orientation changes everything. Losses no longer feel urgent. Wins no longer feel euphoric. Both are simply confirmations that the distribution is unfolding. Emotional neutrality becomes the default state. Many traders chase consistency by refining entries, adding indicators, or optimizing parameters. But consistency is not created by better signals. It is created by stable behavior, and stable behavior cannot exist in an environment where outcomes dominate perceptio. And the market environment is noisy, outcomes are misleading. A losing trade can be executed perfectly, a winning trade can be executed poorly. When traders judge themselves by outcomes, they reinforce bad habits and punish good ones. Probabilistic thinking corrects this by shifting the evaluation metric from results to execution quality over a series. This is why consistency often improves dramatically once traders stop caring about individual trades. Not because they stop caring about money, but because they stop demanding emotional feedback from randomness. The trader who thinks probabilistically understands that patience is not waiting. It is trusting the process enough to not interfere. Interference is the enemy of consistency. Every time you override a rule because of a recent loss or a recent win, you inject randomness into your behavior, destroying the statistical integrity of your edge. Consistency is not a personality trait. It is a logical consequence of thinking correctly about probability. When traders fully accept that outcomes are random within a known distribution, they stop trying to control them. They stop negotiating with the market. They stop needing reassurance. Execution becomes mechanical, calm, and repeatable. Over time, this repeatability produces consistent results, not because the market becomes predictable, but because the trader becomes predictable to themselves. And that is the paradox of trading. The more you accept uncertainty, the more consistent your results become. Consistency does not come from knowing what will happen next. It comes from behaving correctly no matter what happens next. Most traders believe their edge is technical. They search for better entries, cleaner patterns, faster indicators. But if technique alone created consistency, everyone with the same chart would have the same results. They don't, because the real edge is not what you see. It is how you respond to what you see. The market is an environment designed to provoke emotion. Every tick tests patience. Every loss challenges confidence. Every missed opportunity triggers regret. If you have not mastered your internal responses, the market will exploit them relentlessly. Not intentionally, but inevitably. Traders do not lose money because they lack intelligence. They lose money because emotion quietly hijacks decision-making at the exact moment it matters most. Emotional self-control begins with awareness. The moment you place a trade, you expose your deepest beliefs about control, worth, and expectation. If you believe winning proves competence, losses will feel like failure. If you believe the market owes you fairness, Randomness will feel like betrayal. These beliefs operate beneath conscious thought, yet they dictate behavior. This is why traders often break rules they intellectually agree with. Under emotional pressure, the mind does not seek truth. It seeks relief. Relief comes from acting, not from being correct. Cutting winners early, holding losers too long, overtrading after losses. These are not strategic errors. They are emotional coping mechanisms. The trader with true emotional self-control does not suppress emotion. Suppression creates tension, and tension eventually erupts. Instead, they remove the conditions that generate destructive emotion in the first place. They do this by redefining their relationship with risk. When risk is clearly defined and fully accepted before entry, emotion has nowhere to attach. Fear does not arise because there is nothing to protect. Hope does not arise because there is nothing to demand. The outcome is no longer a verdict on self-worth. It is simply data. This is the foundation of emotional self-control. Nothing is at stake psychologically. Most traders say they accept losses, but their behavior reveals otherwise. True acceptance means a loss does not alter behavior. It does not speed you up or slow you down. It does not cause hesitation on the next signal or recklessness after a win. When behavior changes, emotion is still in control. The market does not test your strategy. It tests your ability to remain internally stable while outcomes fluctuate. The trader who can remain the same person after 5 losses in a row is operating from a position of strength most never reach. Emotional self-control is what allows discipline to exist naturally. Without it, discipline feels forced, like holding your breath underwater. Eventually, you must surface. When now control is present, discipline requires no effort. You follow rules because breaking them would feel illogical, not tempting. This is why willpower fails traders. Willpower fights emotion. Understanding dissolves it. The trader with emotional self-control understands that uncertainty is permanent. They stop trying to eliminate it and start organizing their behavior around it. They no longer need certainty to act. They do not need confidence to execute. They do not need comfort to remain consistent. Their edge is not courage, it is clarity. While others hesitate, waiting for confirmation that never comes, this trader executes. While others panic during drawdowns, this trader continues following the same process. While others seek reassurance from the market, this trader relies on predefined rules and probabilities. The market becomes less threatening when you no longer interpret outcomes as personal. A losing trade does not mean you are wrong. A winning trade does not mean you are right. Both are simply expressions of probability unfolding. This neutrality allows traders to see the market as it is, not as they want it to be. They notice subtle changes in conditions without emotional distortion. They adapt when data demands it, not when fear insists on it. Emotional self-control also protects traders from success. Success can be more dangerous than failure because it feeds overconfidence. Traders without emotional control increase size too quickly, loosen rules, and assume skill where luck played a role. Emotional self-control keeps success contained. It prevents arrogance from turning profits into vulnerability. Over time, this stability compounds. Drawdowns remain manageable. Confidence remains steady. Capital grows because behavior remains consistent. The trader is no longer at war with themselves. This is why emotional self-control is the real edge. Strategies come and go. Markets change. Volatility expands and contracts. But the trader who can remain calm, objective, and consistent in the face of uncertainty will always have an advantage over those who cannot. The market rewards those who are prepared to be wrong without emotional consequence. When emotion no longer dictates decisions, execution becomes clean. Clean execution allows probabilities to work. Probabilities working over time create consistency. Consistency compounds into wealth. There is no shortcut to this edge. It is built through honest self-observation, structured risk, and repeated exposure to uncertainty without emotional collapse. But once developed, it cannot be taken away by market conditions. Charts may fail you. Systems may break. Volatility may vanish or explode. But emotional self-control remains. And in an environment where uncertainty is permanent, the trader who controls themselves controls the only thing that ever mattered. The market does not reward intelligence, prediction, or effort. It rewards emotional stability. When you can remain calm, and uncertainty, accept losses without reaction, and execute without needing reassurance, you possess the real edge. Strategies only work when behavior stays consistent, and consistency only exists when emotion no longer interferes. Control yourself, and the market loses its power over you. At that point, profits are no longer chased. They become the natural byproduct of disciplined, emotionally neutral execution over time.